Hi friends, welcome to this segment. So my screen is frozen from my end, but I believe you can hear and see me on the other side. Hopefully, before I finish the introduction, it would have picked up. I'm experiencing this, and I don't know why it keeps happening this way. But let me move on. Let me move on. Hopefully, it will pick up. Okay, so we'll be looking at impairment IAS 36. Okay, so impairment of assets, and looking at how to calculate, how to recognize, and then how to allocate it, okay, reasonably across the assets which are in the books of the company. It's the same impairment when we talk about goodwill. It is the same impairment Nothing is changed, okay. That's why reasonably we say that when you identify any impairment and you want to allocate it to the assets, look at the goodwill, apply it to it first, allocate the rest across the rest of the assets. Again, my screen is still frozen, but I believe you hear me. Okay, so I'll share my screen soon once everything comes back to normal. All right, try this option and go back again. It's working now. Okay, so we're just going to be picking the slides and then we'll look at it. It's one of the easiest topics you can ever see and you would ever love to attempt when you find it in an exam. Okay, so impairment review, we'll be looking at the recoverable amount, the carrying amount, which we know normally appears in the books of the company, of the entity. Okay, value in use, something you've looked at or you've seen in the past. Okay, where we discount it using the present value, not present value of annuity, but present value of a lump sum. Okay, then that's it. We compare it against the fair value less cost to sell. The higher of that, okay, we'll look at that and you will realize that it is one of the easiest we can ever think of. Once again, I'll try and split it into two parts, not to take too much of your time. So quite straightforward, quite easy, and you should be fine. All right, let's move on. So at the end of the day, we want to calculate, define what impairment is. Okay, we'll take a brief look one step back at the conceptual framework in terms of its definition of an asset. Okay, because we're dealing with an asset in this scenario, so we need to look at it. Okay, then we also look at conditions or situations that will give rise to impairment, internal factors, external factors. Then if there is a reversal of an impairment loss, what do? We have initially recognized a loss in terms of impairment, but over the time it has changed favorably. What do? Then we talk of cash generating units, a whole segment of assets that pool resources together to provide value to the company. So one cannot stand alone. It's a unit, it's a whole unit. They all work together. The assets work together. Efficiency is seen across board, not one item standing alone. What do? Okay. And then state the basis on which impairment losses could be allocated. And then, yes. And then we allocate impairment to the assets of a cash generating unit. Any questions you see, you should be able to answer them. Okay. So we're looking at indication of impairment. We look at internal, external. We'll measure and recognize, and we'll look at cash generating and reversal. So for the first part, which would be a little more detailed, we'll be dealing with this as the first part. Okay. And then the second part, I'll come and deal with these two. Okay. So for now, let's look at indications. Let's measure and recognize, and then we come back to the other part. Okay, one at a time. So go back to the conceptual framework. What is an asset? Something we control. We have control over, okay, as a result of past events, and from which we expect to get some future economic benefits. Okay, key things over here in the definition of an asset: controlled, not just ownership. Okay, but we own and control. Okay, so and then past events, as a result of past events. Okay, then we can gain some future economic benefits. If it doesn't meet all three, doesn't meet all three, okay, all three must be met, then we cannot recognize it as an asset. That's why if you take the football companies, for example, the football clubs, Mohamed Salah, right? Mo Salah is a great player for Liverpool, right? is a great player for Liverpool. In fact, Sadio Mane is a great player for Liverpool, right? These guys are seen as assets of the company, right? But when you take the financial statements of Liverpool, you will not see Mo Salah classified as an asset in the financials. Why? Yes, they own him, but do they control him? What if Mo Salah or Sadio Mane gets up tomorrow and says, I want to join Barcelona? What will happen? They cannot decide whether he should know we should go or not. They will gain some future economic benefits from him. They have acquired Sadio Mane from Southampton, but it doesn't mean that they can control him as to where he goes and where he shouldn't go. Okay, so that is why you can see that these football guys are not normally classified as assets on the face of the financial statement. They are assets inherently to the company. But when we come to financial wise, because we do not control them, we cannot classify them, put monetary value on them. And in fact, it makes sense. Can you put a value on human beings? For the sake of economic transactions, we tell you we bought this for some 40 million. We tell you we bought this for some 55 million. That's it. For the sake of financial transactions. But it doesn't mean they have bought the life of that person. Okay. So this is what we want to just look out for in terms of the conceptual framework. Okay, I'll leave it. And again, besides the fact that it can be, there could be future probable economic benefits to the company, we should always be able to measure the cost or the value reliably. Very important. Very important. We should always be able to measure it reliably. Now back to where we are in terms of definition for what impairment is. So we always say that an asset is impaired when its recoverable value is below its book value or carrying amount. We used to say book value, right? But it's the same as carrying amount on the face of the financial statement. Now, so we're looking at the recoverable value. Recoverable amount is below the carrying amount. In effect, what we are saying is that if you should sell this asset, okay, in the books, it is 10 million, for example. But if we go and sell it on the market at an arm's length transaction, how much are we going to raise? How much are we going to raise? That's the recoverable amount. At an arm's length transaction using a free and fair market system, how much will you recover if you should sell it, if you should dispose it of? Now, the recoverable value or recoverable amount is always considered as the higher of the fair value less cost to sell. Assuming you want to dispose it of, what is the fair value that you can sell it for? And what are the intentional costs, the expected cost that you must incur before you can dispose it of? Okay, cost due to disposal. Okay, and then we have it also considering the value in use. And here the key item is the present value. Present value. So we'll be using the present value formula, okay, where we deal with what? You should remember this, okay? Future value times the discount factor, okay? Times the discount factor, okay? Let me just put it this way. Times the discount factor. That's all, okay? Now, this formula, I'm assuming you want to work it out, okay? We've all known from our past history or past financial management basics that future value is equal to what? Present value times what? 1 plus the rate to the power n or to the power time. Okay, this is what we all know. So finding the present value, simply we flip it. We make PV the subject. Okay, so we can simply get a present value to become what? Like I said, this is the first one. I'll just use the first one. The second point, to expand it, will become what? Future value divided by what? 1 plus the rate to the power n. Okay, remember this does not become the discount factor, else you end up dividing the future value by the discount factor. Okay, or we could also get our present value to be what? The future value times 1 over 1 plus the rate to the power n. This is the same as this formula. Okay, this is the same as this formula. Or you could also use a third one where present value is equal to future value times what? 1 plus the rate to the power what? Negative n. Okay, okay, this is the fourth one. I said 3. This is the fourth one. I mean, this and this is the same. This and this is the same. Okay. Okay, so any of these should help you get the same answer. They will give you the same answer. Here, it means you are using the discount factor tables. Okay, you are leveraging on the tables and it gives you the figure. I'll use that one in this illustration. Okay, here it means you are calculating it yourself. Okay, you are calculating it. And again, here you are still calculating it without using the table. And again, here you are calculating without using the table. Once again, we are dealing with present value of a lump sum. Okay, of a lump sum or of a single cash flow. Okay, not the annuity. Remember, not annuity. Okay, I'm not going to financial management not to illustrate the annuity here for you. Okay, otherwise you would have always known when we talk of present value. So when you are using the table, be careful the one you are using. Use the table which has any of these formulas. If you are using the table, any of these formulas, don't use a formula which has present value of annuity. Sometimes you see it as cumulative present value. Okay, and this one has a very unique formula for the discount factor. Okay, where it tells you it is what? 1 over the rate minus 1 all over rate 1 plus rate to the power n. This is annuity, not this one in terms of the table that you'll be using. Okay, not this one in terms of the table. There's another one, another formula for the annuity. Be careful that you are not using that one. So I think it is 1 1 over 1 plus rate. Okay, all to the power negative n all over rate. Not this one. Okay, this formula is the same as this. I'm just flipping it. Okay, 1 minus 1 plus r to the power negative n all over rate is the annuity. This is not the one. Sometimes you take the tables and they will only rating present value. They will not tell it's annuity. Okay, just take note the one you're dealing with. Again, a number of assets are exempt from impairment. Why? Because these guys have specific standards that deal with them. So IAS 2 inventories, construction contracts 11, IAS 11, deferred tax asset 12, employee benefits 19, IFRS 7 and 9 financial instruments and non-current asset held for sale or discontinued operations, IFRS 5, are exempt because they have specific standards that deal with how it is treated. Okay, all right. Now, what factors give rise to impairment? Internally, when there is any evidence of damage or obsolescence, it's an indication. When the asset's use has changed, we used to leverage on this machine always, but now we've stopped using it as we used to. Tells you that its value is dropping. Okay, the use is dropping. Again, when you realize that this asset is performing below par, what we normally expect of this, it produced 10,000 units, now it's only producing 7,000. It tells you that there's some form of impairment. Okay, externally, you could look at decline in the market value. Okay, we could also look at changes in the environment. It could be economic, technological, environmental, legal, any, which could impact the performance. Okay, and then again, we should look at increased interest rates, which tends to reduce the value in use. Present value comes in again. Remember, the higher the discount rate, the lower the value. The higher, the lower the value. Okay. Now, how do we recognize and measure impairments? One, we are being told, and it is easy, something we have known or could even infer that if it is impaired, we should write it down to its recoverable value. Now, the impairment loss should be taken straight to the profit and loss. Charge it to your statement of profit or loss. The only exception is that provided in the past we've revalued the asset and it gave us a surplus. So we would have created a revaluation surplus, kept it in the books. Okay. Now, if there is any impairment loss, we charge the impairment loss to what? To the revaluation surplus. Okay. Assuming that is the situation, we have had a revaluation surplus in the past. Any loss we get today, later on after we have checked the use of the asset and it's impaired, charge it to the revaluation surplus. And if there is any excess, you charge it to the profit and loss. That's it. Okay, that is it. All right. Take an example. So Tintin Company owns a machine, is damaged as a result of a forklift reversing into it. The machine has a carrying amount on the books of 42,000 at the date of the accident. The machine could be sold for. Okay, so this is the fair value less cost to sell. Let's assume we have taken into account any cost to sell. Okay, but if the company continues to use, they said it will generate present cash flows of what? 19,000. So this is what the value in use. The value in use is always linked to what? The present value. Be careful, note this, okay? The question is, how should this be reflected? Remember, we are told, remember, that the recoverable amount is what? The higher of this and this. So which one is higher? This one. So we'll pick this, okay? This is a recoverable amount. Knock it off against the 42,000. So the 42,000 being our carrying amount, okay? Our carrying amount. Compare it to the to the 19,000, which is our recoverable amount, okay? To our recoverable amount. And then the difference gives us our what? Impairment. Our impairment loss. Okay, that is it. So that's all I've said over here. The 42, subtract your 19, and you get 23 as the impairment. Very easy. Which we then charge to the statement of profit and loss as an expense. Debit our P&L. Okay. Once again, remember, as a summary and overview, the carrying value of the company, of the assets, of the assets in the company is the lower of the carrying value in this financial statement and the recoverable amount. The lower of. Okay. But again, the recoverable amount is the higher of fair value less cost to sell and value in use. And here we are dealing with what? Our present value. Okay. So it's more like a continuum, one fixing into the other. They synthesize, they sing the same story. Okay. So we compare this against that, and then we pick the lower of it. But before we end up picking the lower of these, we need to compare these two elements, which will form the basis, the higher of. Any of these two will form the basis of our recoverable amount. Okay. Sorry. Again, recoverable amount is what? The higher of fair value less cost to sell and value in use. Present value, discounted feature of cash flows. Okay. So once again, like I said, fair value less cost to sell. We are talking of if we want to sell it on the market and we are going to incur some administrative charges, some legal fees, anything you can talk of, marketing expenses, subtract them and get what will be the net value, okay, out of the disposal. So what any knowledgeable parties are willing to exchange in an arm's length transaction, less any cost to sell, the net proceeds is what we term as the fair value less cost to sell. So if you had seen normally, you see fair value minus cost to sell. Don't be confused. We are not saying fair value means cost to sell. We are simply saying fair value less, okay, subtract cost to sell. Okay, it's the same thing. Some slides. Okay. And then we say present value, okay, discounted the cash flows will form the value in use. Okay. Now we are saying that this discount rate will always be the pre-tax rate, and it should reflect the assessment of the time value of money, in which case discounting comes into play. Okay, in which case discounting comes into play. And then we also consider the specific risk to the assets for which future cash flows may not have been adjusted. Okay, so simply we're talking of the discounted cash flows. All right. Let's take another example on the recoverable amount. So Sato owns a car it was involved in an accident. It is barely usable, so the value in use is given as 1,000. One is given to us. Okay. However, the car is a classic one and there's demand for the parts. This results in a fair value less cost to sell. So ideally, our recoverable amount will be what? The higher of this and this. Easy. We pick that one, right? So surely we are going to be picking the 3,000 as our recoverable amount, right? As our recoverable amount. But remember, we were told that we should always compare the recoverable amount to the book value, to the carrying amount. Let me not use the word book value, to the carrying amount. What is the carrying amount? The question says the opening carrying amount was 8,000. So we need to find the closing carrying amount and compare it to this. And then the car was estimated to have a life of 8 years from the start of the year. Okay, so you don't just have to consider this on the face value that it is a carrying amount. Okay, this makes the work quite dynamic. Always at the end of the year is important. Identify the recoverable amount. So what I would do is that my 8,000, I'll divide it by the 8 years. Okay, that's the depreciation roughly. Let me just say that it is my 8,000 times my 1/8, the depreciation. Okay, to get what is expected. So it tells me that my 8,000, my depreciation for each year is 1,000. Okay, so at the beginning, the opening balance would be my 8,000, okay, and then less my depreciation of 1,000. This gives me my book value or the carrying amount at the end of the year, which is 7,000. Compare your carrying amount to the recoverable value of 3,000. Sorry, why am I writing 8,000 again? Compare this, okay? Let me just asterisk it against this 3,000. And you realize that the difference between the two will become what? The 7,000 minus the 3,000, giving me my 4,000. This becomes my impairment, which I charge to my profit and loss. Easy, right? Very easy. So like I said, we're picking this. Opening balance is this, the depreciation figure. This is the net carrying amount, okay? Impairment, this is the recoverable which we found, so the difference becomes the impairment. Very easy, which we charge to the profit and loss. Let's take a detailed example and we'll leave it there. And we'll continue with the other side, okay? On the other side, let's look at this. Spectre has a single manufacturing plant, carrying value 479. So we've been given a carrying value, okay? We've been given, is it at the beginning or at the end? The question will tell us. If there's no mention of beginning at the end, we'll leave it, 749,000, okay? A new government legislation came into place and it restricted exports of products. As a result, we have been seeing that the production capacity has reduced by 40%. This tells us it's an indication of what? An external indicator of impairment. Government legislation. Okay. Cash flows have been prepared, derived from the most recent financial forecast for the next 5 years, approved by management, excluding the effects of general price inflation. Okay. So these are the cash flows. So we already have what? Let's take it one step. We have the carrying value, carrying amount. We need to compare it to the recoverable amount, okay? Now, over here, cash flows for year 1, year 2, year 3 is given, okay? Is given. And the final one is when including disposal proceeds. Everything has been included. If the plants were sold now, we'll realize 550 net of selling cost, sorry. So this gives us what? Our fair value less cost to sell. So we are now finding our recoverable amount. We have the carrying amount 749. Okay, I can put it here 749K as the carrying amount. We have the fair value less cost to sell, given also here 550. Now let's find the value in use. So this, of course, becomes our value in use. And we need to discount all of these future figures to their present value and compare it to the fair value less cost to sell. All right. We are told that Spectre estimates pre-tax discount rate to be 15. So your discount factor per each year, we need to find 1 over what? 1 plus the rate to the power n. N is the time. Okay, n is the time. And r is the rate. Okay, so for year 1, it will simply be 1 over 1 plus 0.15 to the power 1. It gives you a certain answer. Okay, do the same thing for year 2, year 3, year 4. So year 5, for example, will simply be 1 over 1 plus 0.15 to the power 5. Okay, If you are given this in the question, easily use them. If not, you can calculate to cross-check. So that's what we've done. I'm using 5 decimal places. You could use 4. Don't go below 3, okay? So that your approximation doesn't go off. Okay, 3, 4 is normally okay. So this is what you get in terms of your discount factors. And I said, simply use 1 plus the rate to the power n. This gives you the discount factor, where R is the rate, and rate is giving us what? 15%. And then the n is the time. And you have the time in years, okay? So the time is this. This is the time. All right, we got it. So we just move on. Recoverable amount is the higher of this. We have this from the question. We are looking for this guy, okay? So let's simply discount all our future values. Future values, yes, to a present value. So plug in here all your future values. Multiply it against your present values, and then you sum all of them up, okay? So this is what we get. All your future values for the years. Multiply them against each discount factor, and you get these answers, right? And then you sum all of them up to get 638,000 value in use. Now let's compare. Fair value, okay, less cost to sell is 550. And then a value in use is 638. We have been told the higher of. So it means we end up picking this one. And then we compare this 638,000 to the 749, okay? To the 749. What's the current amount? 749,000. What is the recoverable? 638. In effect, knock it off and you get 111. Okay. Now, if this 111, which is the impairment loss, assuming there had been a revaluation surplus somewhere as a result of this same asset, or even if it's pool of assets, which we term the cash generation unit, what you have to do is that go and run this against the surplus. Okay, so assuming the surplus was, let's say, exactly 11, let's say 110, we knock the 111 off. The left is still 1. So the whole of 110 should go off to the revaluation surplus, okay? And then the extra 1 should go to the profit and loss. But here, we are not told that, so we just assume that there's no revaluation surplus. Instead, the whole of this 111 is charged to the profit and loss, and the corresponding goes to reduce the asset value in the books. Okay. All right. Finally, let's wrap up here, and then we'll come back again. Impairment. Consider the carrying amount, carrying value in the books, and it is just the lower of the carrying value, and then the recoverable amount. The recoverable amount deals with the higher of the fair value less cost to sell, and the value in use, where we talk of discounting future cash flows to get a present cash. Okay, that is it. I'll leave it here. We'll continue with the reversal of impairment, and then that should be it. Okay, so friends, that is it. If you take the example, the tutorial questions, you see some good blend of questions there, which you should help you to run it out. Okay, if you see this in an exams anywhere, it should be a cool chop. Very easy. Very, very, very easy. All right. See you, friends. Take care. Bye for now.